students, welcome to my live teaching learning session of BECC 133 Principles of Macroeconomics. In previous session, we have discussed introduction to macroeconomics. It means I have explained that what is the meaning of macroeconomics, what are the major issues of macroeconomics, and what is the why we study macroeconomics. What are the main purpose to study behind this macroeconomics? All these topics we have covered in previous session. So in today's session, we will discuss about national income accounting. National income accounting is very important topic, and this topic will tell us what is the meaning of national income, how national income is calculated or estimated, what are the aggregates of national income, what are the uses of national income accounting? It means why we estimate national income and what is the purpose behind this national income accounting. And next we will study about limitations. What are the limitations of national income accounting, and what is real GDP, nominal GDP, what is the difference between real and nominal GDP, how GDP deflator is estimated. So all these topics we will cover in today's session. So let us start from first topic, national income accounting. The main outline of this session is that functions of national income accounting, gross domestic product, these are aggregates of national income like GDP. GDP is gross domestic product. Next is how GDP is estimated with the help of value added approach or value added method. Value added method is also known as product method or output method. Second method is expenditure method. How GDP is computed with the help of spending method or expenditure method or outlay method, all are same. Next is third method is how GDP is estimated with the help of income method or factor payment approach. Next is real versus nominal GDP. What is the difference between real and nominal? And what problems we have to face while calculating GDP by different approaches. So all these topics are the main topics which exist in this national income accounting. Next is what is the main objective of this national income accounting? In this national income accounting topic, the main objectives are, number one is, in this session, we will explain the circular flow of income or circular flow of economic activity and income, because this topic starts from circular flow of income. Next, we will discuss the different aggregates or national income accounting aggregates like GDP, GNP, NDP, NNP at market price and factor cost, and stock and flow. What is the difference between intermediate goods and final goods? Next, we will explain the various concepts of national income like GDP, GNP, NNP. And next is to discuss and analyze the different methods to measure national income. And next is to understand the advantages of national income calculation in global perspective. So these are the objectives behind the study of national income accounting. It means when we know about national income accounting, its aggregates and different methods to calculate, then we can understand all the economic activities, and we can calculate national income at global perspective also. So these are the main objectives of national income accounting. Now, next is introduction. In this national income, first of all, we must have to understand the concept of national income because we are talking about national income accounting. So, in this topic, we have to know about what is the meaning of national income. National income is an uncertain term which is used to interchangeably with national dividend, national output, and national expenditure. On this basis, national income has been defined a number of ways. In common parlance, national income means the total value of goods and services produced annually in a country by the normal resident of a country in an accounting year. Because national income can be defined in three ways, because there are three methods to calculate national income, and the three methods of calculating national income are value added method, income method, and expenditure method. So, national income can be defined in different ways, like according to value added method, national income is the sum total of all final goods and services which are produced by the normal resident of a country in an accounting year is called national income. And according to income approach, national income is the sum total of factor income. We know that factors of productions are four. One is land, second is labor, third is capital, fourth is entrepreneur. And all these factors get reward in terms of rent, interest, wages, and profit by rendering their services in production of goods and services. So all factors income in form of rent, interest, wages, and profit, if we add all these factors income, then we can estimate national income by income method. And the last method is expenditure method. And according to this expenditure method, we can define national income, that national income is the sum total of all expenditures made by private individuals, government sector, inform sector, and rest of the world sector. So all expenses which incurred by private individual person plus firm sector's expenditure plus government sector expenditures plus rest of the world expenditures in form of exports and imports, if we add all these things, then we can get national income by expenditure approach. So national income is a very wider concept, is a very broader concept which can be defined in different ways. But in common parlance, we can define national income, which is the sum total of all the final goods and services produced annually in a country. So, this is the definition of national income. And next is, this is simple flow of income or circular flow of income. In a very simple way, how we can define what is the meaning of this circular flow of income. In circular flow of income, we know that in each and every economy, three main activities always done, and if all these activities smoothly done, then economy can run very easily. Otherwise, if any activity disturbed, then whole economy will get affected by these disturbances. Number one is, first of all, household. There are, if we assume that there are only two sectors in the economy, one is household sector Other is firm sector. Household sector is that sector which is the owner of all the factors of production. We all are included in household sector. Household sector is called owner of all the factors of production like land, labor, capital, entrepreneur. And household provide means of production to the firm sector. Firm sector is producing sector who produces goods and services for the consumption of household sector. So household provide factors of production to the firm sector, and firm will produce goods and give it to household sector. So firm generate income. Firm gives income to the household. When firms rendered their services, when firms rendered the services of factors of production, then firm will give income to all these factors of production in form of rent, interest, wages, and profit. So all these income will go to household sector, and household sector then spend this money on all goods and services which are produced by firm sector. So income goes to uh, household sector from firm sector, and expenditure goes to firm sector through household sector. So in this way, first of all, firm will provide income to the household sector. Then household will spend this money income on goods and services, and it will again go to firm sector. So this flow goes on continuously. That is called circular flow of income. First of all, goods are produced, then income will generate, then money will spend on goods and services for the satisfaction of consumer wants. So again, this process will continue. Again, income will generate, and then expenditures will be done. So this process is known as circular flow of income. But this is the very simple circular flow of income because we have assumed that only two sectors exist in the economy. But at present, in real world, there are four sectors exist in the economy. And what are these four sectors? These four sectors are household sector, farm sector, government sector, and rest of the world sector. At present, in each and every country, four sectors exist in the economy. One is household. Household generally is the called owner of all the factors of production. Farm is known as producing sector. Government, you know that without government interference, economic activities can't run smoothly. And rest of the world, at present, all the economies are open economies. All have relationship with rest of the world. All countries are engaged in international trade activities like they are doing exports and imports with rest of the world. So at present, four sectors exist in the economy. That's why circular flow of income we can study in a two-sector economy when only firms and household sector exist, in a three-sector economy in which firms, household, and government sector are included, and in a four-sector economy in which firm sector, household sector, government sector, etc. And firm sector pay GST, firm sector government impose indirect taxes on firms. So GST is the example of indirect taxes. Government collect revenue through taxes, direct and indirect, and government will not give directly any payment uh, in a reward of paying taxes. Taxes are unilateral payment, taxes are compulsory payment, and no one can directly receive any amount from government because taxes payment is not called uh, double entry system. It is not based on double entry system. So this is the income of unilateral, or it is the payment of transfer payment, or unilateral or one-sided payment. So generally, government collect revenue through taxation, and taxation in this we include two types of tax: direct and indirect. Household pay direct taxes to the government sector, and firms pay indirect taxes to the government sector. Government provide subsidies to the farm sector, and government provide transfer payments like old age pension, scholarship, gifts, grants, and unemployment allowance, etc., to the household sector. So this is the main role of government sector. Next is rest of the world. Through rest of the world, we can do exports and imports. And export, if we do exports to the abroad, then income will received by firm. And if we do imports from the rest of the world, then income we have to pay for the import bill to the rest of the world. So, export minus import generally done with this rest of the world. This arrow, this here red arrow is showing that this globe is called rest of the world sector. This is farm sector, and this is government sector, and this individual person or household sector. So household sector provide means of production to the firm sector, firm provide goods and services to the household sector, government collect revenues through taxation by firms and household sector, and then government provides subsidies and transfer payments to the farm and household sector, and payment for imports goes to rest of the world, and payment from exports received by firms. So this is circular flow of income in a four sector economy. Now, national income can be estimated by adding all these components like C. C is known as consumption expenditure, I is known as investment expenditure, G is government expenditure, and X minus M is net export or export minus import. So this C plus I plus G plus X minus M is indicating that national income is the sum total of all these four sectors expenditures, like household spend on consumption expenditure, firm will spend investment expenditure, government will spend money on purchases and other things like transfer payments and subsidies. This is known as government expenditure. And with the rest of the world, we can do exports and imports. So export minus import is the uh, main thing which is calculated by by subtracting exports value minus import value, we can get net exports. And if we add all these things, then we can estimate GDP by spending method. Next is national income. Now, national income is the sum total of all final goods and services which are produced in an economy during an accounting year. Generally, 1 year. Accounting year means 1 year. National income is a flow concept because national income is calculated annually and every year. And the concept which is related with per day, per month, per year, per hour, that is known as flow concept, because flow concept is that concept which is related with period of time, not a point of time, but stock concept is related with point of time. So national income is estimated annually or every year. That's why national income is a flow concept. And the concept of national income or aggregates of national income are: number one is GDP. Here G refers to gross, D means domestic, P means product. Next is GNP. G is gross, N is national, P is product. Next is NDP. N is net, D is domestic, P is product. Next is NNP, N is net, other N is national, P is product. So, gross domestic product, gross national product, net domestic product, net national product, and per capita income, all these things can be estimated with the help of national income. These are the aggregates. We can estimate if we have given GDP, then we can convert it into GNP. If we have GNP, then we can convert it into NDP. And if we have NDP, then we can calculate NNP. National income is estimated always on NNP FC. NNP means net national product and FC is factor cost. And per capita income is the income of individual person, which can be estimated by dividing national income to population or median population. Now, national income accounting is a set of rules and definitions for measuring economic activity in the aggregate economy, that is, in the economy as a whole. So, national income we always study in macroeconomics. It is a part of macroeconomics because national income always measures the economic activity in an aggregate level or in the economy as a whole. National income accounting is a way of measuring total or aggregate production. Next is the difference between GDP and GNP. What is the difference between gross domestic product and gross national product? In simple words, first of all, we must have to know about what is the meaning of GDP and meaning of GNP. Then we can clear and we can differentiate between these two concepts. Now, GDP refers to gross domestic product, and GDP measures the domestic level of production of goods and services in a given period of time. GNP stands gross national product and it measures the level of production in given period of time of any person or corporation belonging to a country. In the concept of GDP, we can take all the final goods and services which are produced by resident and non-resident of a country during an accounting year. But while estimating GNP, we take the total value of all final goods and services which are produced by only normal resident of a country in an accounting year. In GNP, we will not take the production of non-resident people. We always take normal resident persons' contribution in production. But in GDP, we can take both the persons like resident and non-resident. If both are giving contribution in the production of goods and services during an accounting year, that can be included in GDP, but not in GNP. So GNP is a geographic, GDP is a geographic concept, and GNP is an economic concept. GDP shows the strength of the country, domestic country is domestic in territory, and domestic territory is a territory or boundary in which we include political boundary and economic boundary both. Domestic territory is a broader concept. In this concept, we include two types of boundaries. One is political, other is economic. Political boundary tells us that what is the political boundary of Indian economy. And economic territory means where we get income, like Indian aeroplanes, Indian shipping corporations, when go to rest of the world and earn income for Indian economy. So This is known as economic territory. So, economic territory and political territory, if we add these two types of territories, then we can define this domestic territory. So, GDP shows the strength of the country's domestic economy, and GNP shows the contributions of resident towards country, not non-resident. GDP is location based and GNP is citizenship based. Only citizens uh, who are giving contribution in the production of goods and services, only their contribution is included in GNP concept. But resident and non-resident both contribution can be added in GDP. So this is the basic difference in GDP and GNP. And other difference is that in domestic territory, net factor income from abroad is not included, and GNP, net factor income from abroad, is included. If we add net factor income from abroad, which is the difference between income received from abroad and income paid to the abroad, if we add this NFIA in GDP concept, then we can get GNP concept. And if we deduct NFIA from GNP, then we can get GDP concept. So we can convert GDP to GNP and GNP to GDP. Only the difference between domestic and national is net factor income from abroad. And net factor income from abroad is the difference between income received from abroad and income paid to the abroad. Now next is intermediate goods and final goods. What is the difference between intermediate and final goods? Intermediate goods are those goods which are used for production of goods and services, and final goods are those goods which are ready or which are finally consumed by consumer. It is clear by its name that intermediate, which is used as a raw material for making goods and services, and final goods are those goods which can be used directly or it is ready for use to the consumer. So, final goods are used for final consumption. Intermediate goods remain within the production boundaries, but final goods are outside the production boundaries. Intermediate goods, in the production process, value is added to intermediate goods, but there is no value added in case of final goods. It means like wheat is a raw material. If we are making chapati, then chapati is a final good, and biscuit, if we are making biscuit from maida, that is maida is a intermediate good and biscuit is final good. And final good, if final good is ready, then no value can be added to these final goods. But in production process, raw material value can increase. So in production process, value is added to intermediate goods. Intermediate goods are not included in the estimation of national income. Why? Because if we add intermediate goods and final goods both, then double counting problem will create. So to avoid double counting problem, we always include final goods and services in the estimation of national income, not intermediate goods. For example, milk purchased by a restaurant. If a restaurant purchases milk, that is intermediate good. But if milk purchased by household, that is final good. So if a car purchased by consumer or a person, that is final good. But if car is purchased by Ola cab driver, then and used for driving and for commercial purpose, that is intermediate. So any good can be intermediate and final. It depends upon their use. Who is using that commodity? If consumer is using that commodity, that is called final good. If firm sector is using, or if any production unit is using that thing, that is called intermediate. So in national income estimation, we should always include final goods, not intermediate, because intermediate goods create double counting problem. Next is national income accounting and product accounts. It measures the output and income in the economy. According to national income accounting, national income and product account measures output and income in the US. Simon Congenet's economics said that, and its established team estimates actually national income, and it developed in 1930s at NBER and US Department of Commerce during World War II. Congenetz was an associate director at the US War Production Board. At that time, Simon Congenetz gave this concept that national income accounting and how we can estimate this national income. Next is national income accounting. There are three methods to calculate national income. One is value added method, second is income method, third is expenditure method. First is value added method. In value added method, we can say this method and we can know about this method. This method is known as product method, and this method is known as output method. So value added method measures the value added by each producing enterprises in the production process in the domestic territory in an accounting year. In other words, value added is defined as the difference between total value of output and intermediate consumptions. If value of output minus intermediate consumption, or if we deduct intermediate goods from value of output, then we can get value added or GDP or GVA, gross value added, gross domestic product. Both are same thing. Both can be estimated by subtracting intermediate goods from value of output. Next is national income accounting by expenditure method. If we add all the expenditures by all the sectors of the economy, then we can get national income, like C plus I plus G plus X minus M, the summation of different types of expenditures that occur within a country. Here Y is income or national income is equals to C. C is consumption expenditure. Consumption expenditure is made by consumers or household, and investment expenditure is made by farm sector. Government expenditure is made by government sector, and export minus import is related with rest of the world. So these four sectors, when spend money income either on consumption or investment or government expenditures or exports minus imports, then we can get GDP by expenditure method. So here Y is GDP or total production, C is public consumption of goods and services, I represents business firms. Business firms generally spend their money in purchasing of plant and machinery, equipment, software structures, changes in business inventories, and residential investment. G is the purchases of goods and services by state, local government, or central government. Because in India, there is a federal government system. And in federal government system, there are three types of government included. One is state government, central government, and local government. And export means exports of goods and services. X represent exports and M represent imports of goods and services. And the difference between export and import is known as net export. Now next is national income by income method. National income is always estimated at NNP at factor cost. N is net, other N is national, P means product at factor cost. NNP at factor cost means net national product at factor cost, which can be estimated if we have given GDP at market price. If it is given, then we must have to deduct net indirect taxes. Then we can converted market price into factor cost. And if we less depreciation value, depreciation is the wear and tear expenditures or obsolescence cost or maintenance expenditure, then we can convert gross into net. And if we add net factor income from abroad, then we can convert domestic into national. So if we deduct net indirect taxes from GDP and deduct depreciation from GDP and add NFIA, net factor income from abroad, in GDP, then we can estimate NNP at factor cost, net national product at factor cost. NFIA can be positive, can be negative. It depends upon that how much income we received from abroad and how much income we paid to the abroad. So net factor income from abroad is the difference between income received from abroad and income paid to the abroad. If income received from abroad is more than income paid to the abroad, then it will be positive. And if income received from abroad is less than income paid to the abroad, then it will become negative. So net factor income can be positive, can be negative. Receipt of factor income from the rest of the world minus the payment of factor income to the rest of the world, this is called net factor income from abroad. You must have to remember three things: that how we can converted gross into net, domestic into national, and market price into factor cost. The basic difference between these three concepts, like one concept is market price, like GDP at MP and GDP at FC. So what is the difference between these two concepts? Only one difference. GDP is same, but one concept is on market price and other is on factor cost. So how we can convert it market price into factor cost and factor cost into market price? There is only one thing. There is only one difference which lies in between of these two concepts, and that difference is net indirect taxes. Net indirect taxes is the difference between indirect taxes and subsidies. You know that indirect taxes, when a commodity offer for sale in the market, then government impose taxes on that commodity, which is known as indirect taxes like GST. So when commodity comes in market for sale, then indirect taxes add in the price of that commodity, so price will increase. If government provides subsidies to the farm sector, then price will decrease. So NIT is the difference between indirect taxes and subsidies. If market price NIT is included, so if we want to convert it into factor cost, then we must have to deduct NIT from GDP at MP. Then we can get GDP at FC. Okay. Next is domestic and national. There are two concepts. One is domestic. GDP is gross domestic product and GNP is gross national product. The basic difference between these two concepts is only one, that is domestic and national. And we can convert domestic into national and national into domestic only by adding one thing, that is net factor income from abroad. If net factor income from abroad is included in GDP, then we can convert it into GNP. And if we deduct net factor income from abroad from from GNP, then we can get GDP. So domestic can be converted into national by adding NFIA, and national can be converted into domestic by subtracting NFIA. Now, third main thing is gross and net. There is a difference between gross and net concept. In gross concept, depreciation value is included, and in net concept, depreciation is excluded. If we have given gross value, then we can get net value. How? Only deducting depreciation. If we deduct depreciation from gross value, then we can get net value. So gross minus depreciation is equals to net value, and net plus depreciation is equals to gross. So gross can be converted into net and net can be converted into gross only by taking depreciation value. If we add this depreciation value in net value, then we can get gross. And if we deduct depreciation value from gross, then we can convert it into net. So there are three main concepts. One is depreciation, which is used by converting gross into net and net into gross. Second is NFIA, net factor income from abroad. Net factor income from abroad is net factor income from abroad is used for converting domestic into national and national into domestic. And third is NIT, net indirect taxes. Net indirect taxes can be used for converting market price into factor cost and factor cost into market price. So this is the main three concepts from which we can get any other concept and we can estimate national income at factor cost. Now next is calculation of national income by income method. So the income method measures national income from the side of payments made to the primary factors of production in the form of rent, interest, wages, and profit. We know that factors of productions are four: land, labor, capital, entrepreneur. Land gets reward in form of rent, labor gets reward in form of wages, capital takes reward in form of interest, and entrepreneur get in reward profit. So all factors of production get reward in form of rent, interest, wages, and profit. After rendering their services, they get reward in terms of this. So components of domestic income is equals to: one is compensation of employees. This is the reward or compensation paid to the employees for rendering productive services. It includes wages and salaries, employers' contribution in social security schemes, and dearness allowance, bonus, city allowance, house rent allowance, leave traveling allowance, etc. So, in compensation of employees, we include all these things. If in a numerical question compensation of employees is given, then we will take only compensation of employees. But if compensation of employees is not given, instead of this COE, we have given salaries, wages, employers' contribution, bonus, house rent, then we can add all these things and we can get compensation of employees. Now, second is operating surplus. Operating surplus is the sum of rent, interest, and profit. All these three income. Rent and interest is the income received by and property. If you have property, then you can get income in form of rent and interest. And entrepreneur always get income in form of profit. So it includes rent, interest, and profit. Profit includes corporate tax, dividend, and undistributed profit. Profit has further subdivided into three parts. One is corporate tax. Corporate tax is profit tax. Undistributed profit is that profit which is not distributed by a company or a firm on the uh, shareholders. This income is known as retained earning, which is used for further expansion or further development of the companies. And dividend is the part of profit which is distributed among shareholders. So profit has three parts: one is corporate tax, other is dividend, and third is undistributed profit. So if we add rent, interest, and profit, then we can get operating surplus. And the third component of domestic income is mixed income. Mixed income is the sum of income from work, income from property, and income from entrepreneurship. In India, there are so many people are earning mixed income. We can't classify their income into only one category, like income from work, how much they are earning, income from property. They are earning from all the sources like income from work, income from property, and income from entrepreneurship. If any person is getting income from these three sources, that person income is known as mixed income. For example, doctor's income, lawyer's income, teacher's income, any professional's income is known as mixed income because they can take income from so many multiple sources like primary sector, secondary sector. If we are getting income from primary sector, simultaneously we are getting income from secondary sector and tertiary sector. If a person is earning all these sectors income, then we can get mixed income. So there are three components of uh, NDP at FC or domestic income. One is compensation of employees, second is operating surplus, and third is mixed income. If we add these three components, then we can estimate NDP at FC, net domestic product at factor cost, which is known as domestic income. Now next is what items we should exclude from national income accounting. The items we should exclude from national income accounting is second hand goods. Second hand goods not included in the estimation of national income because when a good produced, uh, fresh good, or first time, if a good commodity produced at a first time, that is included in the estimation of national income. So if that commodity sale again and again, or second hand goods are sold or purchased, that is not estimated in national income accounting, otherwise double counting problem will occur. Second is intermediate goods. Intermediate goods are not included in the estimation of the estimation of national income because it also create the double counting problem. Non-marketed goods, the goods which are not sale in the which provided by any individual person voluntarily or household activities. um, if we are doing any household activities like gardening, and if father is teaching his son or daughter, then father will not get income by his son or daughter. So that is called voluntary work. So voluntary work or non-marketed goods are not estimated in the estimation of national income. And illegal income, illegal transactions, unreported income, these all are not included in the estimation of national income. Same as share, bonds, debentures, all financial securities or financial assets, sale and purchase are not included in the estimation of national income, but the broker's commission included in the estimation of national income. Any type of taxes, either it may be direct or indirect, taxes are always unilateral payments, one sided payment, they are transfer payments, they are not included in the estimation of national income. So we should remember these things, that second hand goods, intermediate goods, non marketed goods, voluntarily services, illegal activities, and transfer payments, unilateral payments, not estimated in the not included in the estimation of national income. Next is this concept of national income. Uh, these are different concepts of national income like GDP. We have discussed about this. GNP is gross national product. NNP is net national product. And NP at FC is national income. Next is personal income and disposable personal income. So all these are the aggregates of national income. Personal income, through national income we can get private income, through private income we can get personal income, and personal disposable income is actually income which is received after paying the direct taxes by the household, and household sector is freely spent this money income which is received by deducting or by paying the direct taxes. So this is called disposable personal income, which is received by the person after paying the direct taxes from their money income. Now next is formulas, different formulas. NNP at MP, if we want to calculate it, GNP is given, then we have to convert it only gross into net. All things are same. Remaining things are same, but gross and net, there is only one difference. That is gross and net. If we deduct depreciation from gross value, then we can get net value. Net domestic product, if we want to calculate from GDP MP, then we must have to deduct depreciation. NDP-MP to FC, NDP is same. We have to change only market price to factor cost. NIT, we have to deduct NITs, net indirect taxes. GDP-FC, if we want to estimate, NDP-FC is given, then net, we have to convert it into gross, depreciation will be added. And if GDP-MP is given, NNPFC we want to calculate, first of all, we have to change gross into net, depreciation will be deducted, the domestic into national, NFIA will be added, and market price into factor cost, NIT will be subtracted. Then we can calculate NNP at FC. So all these are the formulas of calculating national income. National income accounting, there are three methods. We have discussed about all these three methods. That one is value added method, which is known as product method and output method. Second is income method, and third is expenditure method. So if we want to calculate net value added at factor cost or NDP at FC from the following data, first of all we will take sales. Here in value added method will be used in this numerical, because here purchases of material is given, depreciation is given sales, excise taxes, indirect tax, opening stock, intermediate consumption, and closing stock is given. First of all we will take sales, then we will add change in stock. Change in stock is the difference between closing and opening. So sales plus change in stock minus intermediate consumption, then we can calculate gross value added at market price. So how value of output is estimated? Value of output, if it is already given, then we will take value of output. If value of output is not given, then we can calculate it by adding sales and change in stock. So sales plus change in stock is equals to value of output minus intermediate consumption, and then we can get gross domestic product at market price by deducting depreciation and net indirect taxes. Then we can get net domestic product at factor cost. Now next is national income and per capita income. How national income is estimated? We have studied about this. There are three methods to calculate national income. Now per capita income is estimated by dividing national income to total population of the country. National income is equals to NNP at FC. NNP at FC is divided by total population of the country. Then we can estimate per capita income. Per capita income is per person income. It is estimated on an average basis. It is not show the clear or accurate income of the country people. Some people income may be higher this per capita income level, and some person income may be lower this per capita income level. Now next is this is the formula, like GDP MP. If we add NFIA, then we can convert it into GNP MP, and GNP MP is converted into FC by deducting NIT, net indirect taxes. NNPFC is converted, if it is converted into GNP MP, this will be GNP, not NNP. GNP is converted into NNP by deducting depreciation. So national income is always equals to NNP at FC. Now next is there is the total three. Say that GDP by expenditure method, we take consumption expenditure, government spending, investment expenditure, and exports minus imports, then we can get GDP. And if we add all factors income in form of rent, interest, wages, and profit, then we can estimate GDP at by income method. And if value added from each of the main economic sectors like primary, secondary, and tertiary, and if all these sectors income we added, then we can estimate GDP by output method. Next is this is also the identity of national income accounting, in which three methods are given, like how GDP or GBA at MP is estimated by in by value added method, by income method, and by expenditure method. This graph is showing the three different methods of estimating national income accounting. Now next is personal income. Personal income is received by the person or household before payment of personal taxes. After payment of personal taxes, it will convert it into personal disposable income. Personal income is estimated on the basis of national income. In national income, if we deduct indirect business taxes minus corporate profit tax minus interest and miscellaneous payments minus social security taxes, if we add all transfer payments and capital income, then we can calculate personal income. Now, next is the uses and limitations of real GDP. You know that real GDP, when we calculate this real GDP, it is the true indicator of economic growth, because real GDP is always estimated on the basis of constant year price or base year price, and economic growth is the percentage change in the quantity of goods and services produced from one year to the next. We measure economic growth so we can make economic welfare comparison across time. So international comparison across countries also possible with the help of real GDP estimation. And we can forecast business cycles like boom, recession, depression, and recovery stages. Now, what is the uses and importance of national income? National income is very important to calculate, because with the help of this national income, we can measure the standard of living of the country people. We can compare the growth of our country with rest of the world. We can be able to analyze, be able to know and analyze the contribution made and performance by each production sector in the economy, and thus taken ample step for rectification. So it is very useful in measuring inequalities of income and wealth, and it is useful in revealing the expenditure pattern of a country. So national income is very useful. That's why we must have to estimate national income every year, because it's a flow concept. Next is real GDP, real GDP and nominal GDP. If GDP is estimated on the basis of constant year price, that is real GDP. If GDP is estimated on the basis of current year price, that is nominal GDP. Nominal GDP is not the true indicator of economic growth and welfare, but real GDP is the true indicator of economic. Next is GDP deflator. If we take the ratio of nominal GDP to real GDP multiply by 100, then it will be estimated GDP deflator. Next is there are so many problems of GDP while estimating this GDP. GDP ignores the measures the quality of life. Double counting problem sometimes occur if we include intermediate goods. False information is available, then national income will not estimate it accurately. So there are so many limitations of GDP. So we can conclude from this today's session that and national income can be estimated by three methods: value added method, income method, and expenditure method. And there are so many aggregates of national income like GDP, GNP, NDP, and NNP at factor cost, which is known as national income. Thank you.